Some of the steadiest tailwinds in the stock market have nothing to do with the news. In the days leading up to monthly options expiration, the market often drifts quietly higher. No earnings surprise, no economic shock, no headline that actually explains it. Just a slow, patient grind upward that frequently fades once expiration passes. For a long time, people wrote this off as a coincidence or as some vague seasonal magic. It usually is not magic at all. It is the fingerprint of two forces most investors have never heard of. They are called Vanna and charm. And in the week around options expiration, they can quietly steer the whole market. Here is the payoff up front, so you are not waiting for it. An options pull on the market underneath it does not only come from price moving. It also comes from two other things quietly changing: fear, which traders measure as implied volatility, and time, simply passing. Vanna is the force that comes from changing fear. Charm is the force that comes from passing time. The dealers who sold those options have to hedge against both of them, not just against price. And because both volatility and the calendar move in fairly predictable ways around big expirations, the hedging they trigger tends to point in one direction rather than cancelling out. That is why the drift so often leans the same way. You do not have to trade a single option to feel this. You just have to know the two levers are there. To see how, start with who is on the other side of the trade. When investors buy options, and especially protective puts, a dealer usually takes the other side and then hedges in the underlying market to stay neutral. We have walked through the first-order version of this before. As price moves, dealers buy and sell stock to offset their delta. That is gamma hedging. But delta, the very thing they are trying to neutralize, does not only change when price changes, it also drifts when two other inputs move. The first is implied volatility, the market's running price of fear. The second is the calendar itself, the steady countdown toward expiration. Each of those creates its own stream of hedging, completely separate from price. Quants gave those two streams names. The volatility one is Vanna. The time one is charm. So what exactly does each one force dealers to do, and why do they so often push the same way? Start with Vanna, the volatility force. Picture the run-up to a big scheduled event, a Fed decision or an inflation report. Nervous investors buy puts for protection. That demand pushes implied volatility up, and dealers, having sold those puts, hedge by selling stock short to stay neutral. Now the event passes. Whatever the actual outcome, the uncertainty itself is gone, so implied volatility falls. Here is the crucial part. As volatility falls, the delta of those puts shrinks, even if the price of the index has not moved at all. The dealers are suddenly holding more short stock than they now need. To get back to neutral, they buy it back. That mechanical buying, triggered purely by fear draining out of the market, can lift the index on its own. Nobody decided stocks were cheap. Nobody read good news. The hedges simply unwound because volatility came down. Traders call this the Vanna tailwind, and it is one of the clearest reasons markets so often grind higher in the strange calm, right after a feared event finally arrives. Now charm, the time force. Charm is delta decay. As an option marches toward expiration, its delta drifts toward zero if it is out of the money and toward one if it is in the money. This happens just from the clock ticking, with price standing perfectly still. Think about a large pile of out-of-the-money puts that investors bought as insurance. as expiration nears, and as long as those puts stay out of the money, their delta quietly bleeds away. The dealers who hedged them with short stock no longer need as much of that hedge. So, day after day, they buy a little of it back. That is the charm bid, a slow, steady, almost boring pressure that builds through the days before expiration. And here is why this matters so much for that 1 week. Vanna and charm tend to pull in the same direction in that window, both nudging dealers to buy back hedges, which is exactly why analysts watch the week before monthly expiration so closely. The grind it produces is not a prediction about the world. It is housekeeping. It is dealers tidying up positions the calendar is closing for them. And the scale of these expirations has become genuinely enormous. On December 19th, 2025, a single quarterly expiration, the kind traders call quadruple witching, saw a record amount of options roll off at once. Goldman Sachs put the notional exposure at over $7 trillion, the largest expiration on record for the firm. Of that, roughly $5 trillion was tied to the S&P 500, and around $880 billion to single stocks. Goldman estimated the whole pile at more than 10% of the entire value of the Russell 3000. When that much exposure expires in one session, the Vanna and charm hedges attached to all of it have to unwind, and that unwind is a big part of what can give expiration week its push. But here is where an honest channel has to slow down. This is a tailwind, not a guarantee. The drift shows up on average, across many cycles, not on any single day you can circle on a calendar. Plenty of expiration weeks fall instead of rise, because real news or heavily one-sided positioning simply overwhelms the mechanical flow. The effect is real, it is measurable, and it is modest. It is a current in the water, not the tide itself. So the next time the market drifts higher into an options expiration with no news that seems to justify it, you have a sharper question to ask. Not what did I miss, but whose hedges are quietly unwinding right now? Vanna and charm are a lens, not a signal. They will not tell you which way any single week is going to break. What they do is reveal a hidden, mechanical current running underneath the headlines, one that is strongest in the days around expiration and almost invisible if you only ever watch the news. It is the difference between seeing the weather and understanding the tide tables. The forward question to sit with is this. As more and more trading keeps compressing into short-dated options, does this expiration week pull grow stronger and more predictable over time, or does the crowd front-running it slowly compete it away? More breakdowns of the market's machinery are on the way. This channel explains how markets work. It is educational, and it is not financial advice.